Hello friends, welcome to the channel of Rakesh Nanda. This channel is on important aspects in understanding trade finance. We are running an educative series on different topics on banking. In order to remain informed about our subsequent episodes on various topics, please do not forget to press subscribe button and also press bell icon. We assure you that we'll make valuable contents for you to improve your skills on all aspects of banking. So, your small gesture for pressing the subscribe button will motivate us to make more and more interesting videos for you. Let's go ahead. In our series of trade finance as a subject, this is our first episode, which is focused in understanding the concepts of trade finance and also cover various financial and commercial documents essential in any trade related transactions. So let us try to understand various payment options and commercial documents in trade finance as a subject. What is trade? Let's first understand that trade is exchange of goods and services in exchange for money. So there has to be a buyer and there has to be a seller. And there has to be a payment mechanism by which a buyer is ready to pay the amount and seller, in consideration of this payment, is able to supply the goods to the buyer. And here comes the role of the banks. Banks play a very important role in making the buyer and seller comfortable globally, and help them in completing a transaction between both of them. So banks act as facilitators to supplement the requirements of buyer and seller for sending or receiving money, and also ensuring that the goods are transmitted through a specific documented ways, and have banks develop this expertise to verify such documents, which actually helps both seller and buyer in meeting the liabilities or meeting the requirements or complement the requirements of both of them, which is buyer or seller. Let's try to understand what are trade terms. So there has to be a seller in any trade transaction, and there has to be a buyer in any trade transaction. Then there has to be a commercial contract between the buyer and the seller. Now, one may say that, is the contract has to be written? The answer is not necessary. Now, if I give you an example, if you go and buy, say, refrigerator in the market, even though you take an invoice, which is a minimum essential document, but there is no written contract between the company and yourself. It is only the verbal contract which the company which is selling the refrigerator is conveying it to you, that I am warranting against any damage. So you are just buying the goods, and suppose tomorrow there is a damage in the goods. So you claim it from the company. So company, by virtue of this narration that they are selling these goods against this specific warranty clause, they are bound to uh, exchange that particular item as per the warranty terms. Now, this is a commercial contract getting developed automatically, even though there is nothing in writing except an invoice. But there is a binding on the company due to this contract, even though it is a verbal contract. So, company cannot deny the fact that they have given this assurance of warranty and they are bound to pay the damages. But in trade, similar kind of uh, verbal contracts they do happen, but it is always better to have a written contract so that all the terms and conditions are specified in any sale or purchase contract, so that tomorrow if there is any dispute, then this documented commercial contract can help you in the courts of law to get any claims from either the buyer or the seller. That is the advantage of a written commercial contract, so that tomorrow somebody cannot deny you. So you are creating an evidence by way of writing a commercial contract. So it can be both verbal or written, but it is always preferable to have a written contract. But that sometimes doesn't work in this global business, and lot of contracts they actually happen between seller and buyer which works on a verbal basis. Then there has to be goods, uh, which means there has to be something which you need to you are selling, and there has to be a consideration for selling these goods. So these are the minimum terms which you will find it in any trade transaction. Then what could be the concerns of a buyer and seller while selling the goods or buying the goods? So the concern could be the buyer might have a concern of quality, condition of goods, quality of goods, uh, the right time when the goods should be received, the quantity should be received in full, and the safety of goods. These could be some of the concerns of the buyer. Then what could be the concerns of the seller? The seller's concern could be payment as per the terms of the contract. So he must receive the payment in time and there should not be any overdues. So these are some of the reservations which a buyer or a seller has in any selling and buying transaction, which is known as a trade transaction. So now we understand what exactly is a trade transaction which happens in the market. And honestly speaking, banks have got no role to play in such settlements of contracts. It is only between the buyer and seller as to what are the conditions they would like to have for selling and buying. Banks only act as facilitators to help the buyer and seller getting some comfort because of the presence of banks, because banks are highly regulated and they are governed by certain rules framed by various regulatory acts. So their reliability or credibility is very high in the market. So both seller and buyer they rely on this credibility in order to get a help from the bankers who act as catalysts to help both buyer and seller in completing the transaction. So how these the banks help these buyer and sellers to um, complete the transactions? It is done through various documents. So we need to understand what are the payment documents and what are the commercial documents. So the first question comes to mind is why should we sell trade products? Why the banks are pushing these products so much, and why there is so much of demand from the customers, particularly various companies and business outfits who are demanding day in and day out these trade products from the banking channels. So I'm giving a pause so that you can give it a thought as to what could be the reasons why we as bankers should sell these trade products. So one obvious answer which comes to your mind is that it becomes a multiple revenue streams, which means the banks are getting opportunity to make revenue out of selling these products, and it helps in enhancing our return on relationship, which means if the banks are having relationships with certain customers, so it helps them in earning more from that customer. So it's a very obvious inference which might have come to your mind, but can there be something more than this? Please give it a thought. I'm just pausing here for 10 seconds. Please press the bell button as well at that time, and also think about what could be more reasons why should we sell trade products. So you must have given a thought. Yes, you are right. There could be other reasons, and one of the important reasons could be that these are very sticky products. The customers who are using these trade products, they tend to stay with the banks. They become habitual of using these products from the same bank, because not only from the same bank but also the same products again and again, because they find it more useful for their business. They make it more safe for them to handle either the buyer or the seller, due to various properties which we will try to understand through various episodes. So in it becomes more sticky products for the customers to come back to the banks again and again. Then of course, for banks, these are very useful products because it has a self monitoring mechanism. Banks are struggling with failure of various asset businesses, which means whatever they fund is asset business. So there is always a risk when they fund a particular company. So there are chances, there are risks for that company to fail. So they keep on monitoring the performance of the companies. So when companies they use trade products, it becomes more easy for the banks, uh, because these products they have a self-monitoring mechanisms. Say for example, if you have a letter of credit, we'll understand more about it in future in further episodes. But I'm just right now giving a small example if you understand what a letter of credit is, even though we'll talk about it later. But uh, a letter of credit gives an opportunity for the customers, particularly the buyer, to use the credibility of the bank to give an assurance to the seller that yes, the bank will honor the payment if the seller supplies the goods and sends the documents to the banking channel. But when the bank receives such a request from the buyer, so banks definitely do some due diligence on the buyer. Only then they will be ready to open a letter of credit on their behalf. But at the same time, they will keep on watching the performance of the company, and the moment they come to know that the company's performance this month is declining, so they come to know that in the next 3, 4, or 5 months, when this liability of this letter of credit is going to fall on this customer might default. So, since this has a self monitoring mechanism, banks can take adequate steps at the right time in order to ensure that this loss doesn't happen after 4 or 5 months. So it has this kind of a self-monitoring mechanism, and it throws early warning signals so that the banks are saved of the loss. Then, in addition to that, the banks can sell the strength in trade expertise. What does it mean? It means that trade is a business uh, which is not fixed, or it keeps changing globally based on various risk factors, various changes happening globally. So the banks have to keep them aware of such changes, and they have to keep on providing the remedies to cover up these risks, particularly on behalf of the seller and the buyer. So the more informed the bank is about the regulations, about the business being done globally, they are able to provide an expert opinion to the seller and the buyer. And the bank which has more skilled manpower are able to sell their strength to the seller or the buyer so that they use their products or they route their transactions through the bank. And this is a kind of strength which comes through this trade expertise which the banks can sell, that okay, yes, we have the expertise, and we can handle all kinds of transactions, so you route your transactions through us. And last but not the least is, why should we sell trade products? Because we means the banks, because these products are more capital efficient. The trade transactions have a minimal amount contributed to the non-performing assets, which means the bad loans in trade transactions are the lowest. So the banks don't have to earmark much capital for these kind of transactions. So banks find it more lucrative to do more and more of trade business. Let's now understand what are the payment methods in any trade transaction. So primarily there are four types of payments which happen in the trade globally. One is advance payment. What happens in case of advance payment? The seller tells the buyer that okay, you pay me the advance and only then I'll supply you the goods. This generally happens whenever there is a seller's market, because seller is commanding the position. There is a lot of demand of his product. So that's how he can command that okay, unless you pay me advance, I'll not give you goods. So this is known as advance payment. The second could be open account. Now this happens generally whenever there is a buyer's market, because whenever there is a buyer's market, seller has no option, that he has to make his goods available to the buyer and agree to the conditions of the buyer. As and when you feel comfortable, you pay me. So an open account is that seller leaves it open for the buyer, that okay, I leave the goods to you, and you um, pay me at your sweet will. A very good example in the history has been the launch of Maggie way back in uh, early 80s, when Maggie was launched by Nestle. The it happens for various products, but Maggie specifically I'm talking about because it is one of the most successful stories in the Indian history. So when Maggie was launched, people were not in the habit of eating noodles. So it was something new. So Nestle wanted that uh, the moment this product is launched, the people should demand rather than we running after the customers to sell this product. People should demand. So they wanted to make these products available on the shelf so that people come to the shop and they question that, okay, what is this product? And the shopkeeper explains that this is what is the product. So how can that be achieved? That could have been achieved only when the the shops are full of stocks of Maggie. Now, no shopkeeper would be ready to buy a new product because they don't know whether it will be sold in the market or not. So, what they did was they took space on the shelves of various shops, various general merchants across the country. Of course, they went it into phases. First, they introduced it in Delhi, and then in another city, then in another city, like that. So, when it was launched in Delhi, which was the first place where it was launched, one particular day when the product was launched, they ensured that in every shop where they said bread and butter in the morning, their shelves are full of those yellow packets. Even the hanging baskets were introduced, which was the creation of Maggie marketing teams, which is very popular even today. Those baskets, where the baskets were hanged, they used even the airspace for storage of goods. So when the customers they landed up in the morning, obviously when finding so much of yellow around with small packets, they asked, "What is it?" So the shopkeepers explained that this is what is noodle, known as noodle, a new product launched by Nestle, and that is how interaction happened. But as far as the relationship between the seller and buyer is concerned, the relationship was between Nestle and the shopkeeper. So Nestle ensured that the entire stocks were lying in all the shops across, free of cost, and they will pay only when they are able to sell the goods. So this is known as open account. So even in global market today, 80% of the transactions happen open account. So this is how the global business works. Then comes documentary collection. So whenever there is a seller who is uncomfortable with the credentials of the buyer, he will prefer to route this transaction through the banking channels. So when he uses the mechanism of banks in order to uh, uh, route the transaction through the banking channels to complete his contractual obligations with the buyer, then it is known as documentary collections. We'll learn more about it once we go deeper into other episodes. But as far as preliminary understanding is concerned, documentary collection means the seller will be ready to sell the goods to the buyer. He will dispatch the goods to the buyer, but buyer will not be able to take possession of goods. Why? Because the goods will be lying with the transporter, and transporter will give goods to the buyer only if he brings the transport document. But the transport document is not given by the seller to the buyer, and seller gives this transport document to his bank and asks his bank to route this through the banking channel and present it to the buyer, and the buyer will be handed over this transport document only when he pays. So with the result that seller gets a comfort that at least buyer will not be able to take possession of goods unless he pays. And the advantage to the buyer is he is assured that the goods have been received, and once he is paying, he will get the possession of goods from the transport company. So it's a comfort for both seller and the buyer, which is being created through the banking channel. And then last is letter of credit. In letter of credit, seller is further uncomfortable with the buyer's credentials. So he says he's ready to supply goods to the buyer provided he gets an undertaking from his bank, which means buyer's bank, that when the goods are supplied, the documents will be presented by the seller to the bank, and bank is bound to pay. So this means he's using the credibility of the banks in order to get assurance of payment on behalf of the buyer. So this is fourth type of payment, which we'll also understand in detail in our subsequent episodes. So I request all of you to please subscribe to this channel and also press the bell icon so that tomorrow when we launch the next episode, you will be notified with that episode so that you can learn more about these type of transactions. So let's now understand what are the type of documents which are processed by the banks to help both seller and buyer in completing a transaction. So let's first understand bill of exchange. What is a bill of exchange? Bill of exchange has been defined as an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of another person or to the bearer of the instrument. Now, this is a technical language which has been defined in Negotiable Instrument Act. Bill of exchange is nothing but a negotiable instrument in writing containing an unconditional order signed by the maker directing another person to pay a certain sum of money only to or to the order of another person. Let's try to understand this through this specimen. So you see there is a side draft written at the top. Draft here means bill of exchange. Draft here doesn't mean that demand draft in the banks. Draft here is a global language used for bill of exchange, and bill of exchange is an instrument defined in Negotiable Instrument Act as per the definition given on your left. So here there is a seller which is Ajay Enterprises who is selling the goods to William and Company. So you see Ajay Enterprises has issued this bill of exchange which says on 10th of June 2014 he says at site you pay to HDFC Bank Limited or order a sum of US dollar 10,000 only for value received. So what Ajay is to whom Ajay is giving directions, he is giving directions to William and Company, who is a buyer, that you pay to HDFC Bank 10,000 rupees for value received, which means I'll supply you goods worth 10,000 US dollars. And the moment you receive this bill of exchange, you pay to the bank, which is HDFC Bank, 10,000 rupees, and I will deliver you the goods. So it's just an example. HDFC Bank could be State Bank of India also, it could be Punjab National Bank also, it could be an individual also. It's not necessary that this bill of exchange is issued only uh, in favor of HDFC Bank. It could be a person also. It could be Rakesh Nanda also. So what are the various parties in this bill of exchange? So various parties could be five different essential parties. There could be a drawer. So who is a drawer? Who will draw this bill of exchange? So here Ajay Enterprises is a drawer. Who could be a drawee? William and Company could be drawee. And then HDFC Bank Limited or State Bank of India or Punjab National Bank or any individual could be a payee. Then there could be a acceptor. Acceptor means if it is here it was a side draft. Side draft is the moment it is presented, which means it is cited to the buyer is supposed to pay. But suppose Ajay Enterprises is offering a credit to William and Company. Suppose Ajay Enterprises wants to give a 90 days credit to William and Company that he may pay after 90 days. That in that case, it will be a usance draft. So if it is a usance draft, in that case, William and Company will just sign on this bill of exchange when it is presented as a token of assurance for payment after 90 days. So that's why William and Company in a usance transaction will be known as an acceptor. Then drawee in case of need. In case William and Company appoints another person to act on his behalf to handle this bill of exchange, that person will be known as drawee in case of need. So this is a bill of exchange, which is an essential document in a trade transaction, which acts as a catalyst in meeting the requirements of both buyer and seller. What are the functions performed by bill of exchange? So it helps in collecting or demanding payment. It helps in extending credit, as I explained you. It promises to pay, so it is promising to pay on demand and discharge of debt upon payment. So that's the beauty of this bill of exchange. If the way I explained you, there could be two types of uh, draft. One could be a site draft and one could be a user's draft. So if you see the specimen, in the first specimen, Ajay Enterprises has issued, he's a seller, he's issued it in favor of William and Company, who's a buyer, that he's saying that at site you pay to HDFC Bank US dollar 10,000, which means Ajay is telling William and Company that you need to pay 10,000 US dollars the moment this bill of exchange is cited. But in case of the second specimen, you see Ajay is telling William that you pay after 90 days from the date of shipment, because when the goods have been shipped, from that date you count 90 days and then you pay to HDFC Bank 10,000 rupees. So which means he is offering him credit for 90 days. So these are two options available in a trade transaction, site payment or usance payment. Then comes commercial documents. There are various types of other commercial documents which could be there. One could be commercial invoice, consular invoice, customs invoice, packing list, certificate of origin, inspection certificate, or certificate of weight quality. These could be various types of commercial documents which could be there as a part of the trade transaction. Let's try to understand individually these documents. This is a commercial invoice. So if you see, there's a company called Manford who has issued this document in favor of, who is the buyer? The Amco distributor, and trader is the uh, buyer. So Manford has issued this invoice. So invoice actually elaborates as to who is the seller and who is the buyer, what is the invoice number, what is, if the goods are being exported, since in this particular case goods are being exported, so the exporter's reference number, date when this transaction is originating, what was the purchase order number, because AMCO must have given a purchase request, so what is that reference number, what is the destination to which these goods are being sent, even though the buyer is located in London, but he wants goods to be sent to Nigeria. So it's mentioned in the invoice. So how the goods will be carried, whether it will be carried by road or by ship or by what, and then from which place these will be picked up. So ICD Tughlakabad, New Delhi. What will be the port of loading from where the ship will be starting? So in this case, it is Nhava Sheva port in India. What will be the country of final destination? What are the payment terms? So how the payment is going to be made? What will be the port of discharge? What will be the final destination? What is the description of goods? What are the terms of payment? So which is Incoterms, which we will also understand in a subsequent episode as to what are the Incoterms, which are abbreviated terms which are used globally, so that you come to know who is paying up to what stage. Seller is paying up to what stage and buyer is paying up to what stage. Then of course description of goods, quantity in pieces, rate per unit, and total amount of invoice. And then after giving a declaration, the seller is signing at the bottom, which in this case is Manford International. So this is known as a commercial invoice. What is a consular invoice? So consular invoice has looks like this. So what is the definition of a consular invoice? Sometimes what happens is a seller who is sorry, a buyer who is buying from another country is not sometimes aware of as to whether this particular seller is authorized to send these goods from his country to our country or not. So this doubt gets created in the buyer's mind. So buyer, why this doubt gets created? Because he may not be fully aware of the regulations of the seller's country, whether the goods are allowed to be supplied or not. So there could be various reservations. So in case if he wants to be more safe, he can say that he needs a consular invoice. In that case, the seller will have to get his invoice attested from the consular of the buyer's country. So take take the example, say suppose there is a buyer in India who wants to buy goods from say Poland. So a buyer wants that invoice to be a consular invoice. So there is a High Commission, Indian High Commission present there in Poland. So the Poland supplier has to get his invoice attested from the Indian High Commissioner in Poland. That will be known as a consular invoice. So the consular invoice is required by some countries to facilitate customs and collection of taxes. So in certain countries, it is a must that the consular invoice is necessary. Then, what is a customs invoice? So in certain countries, particularly in USA, Canada, and Australia, it is mandatory that you have to issue the invoices only on the customs developed format. So in those countries, the specimen of invoice are structured by customs department. So it has to be ensured that uh, they need to have this customs invoice. They have to issue the invoice on the customs developed format, which is a must. So that is about customs invoice. Then comes packing list. Now, packing list, as the name suggests, it's a very common document. But whenever you are dealing with global trade, it becomes a very important document, even though it might sound as a very common document, but it has to be very professionally made. Why so? Because in global trade, when the goods are sent on commercial terms, they are in large volumes. So the packing list itself should be able to explain as to how these goods have been packed. Say, for example, if you are exporting bottles, water bottles. So the packing list must elaborate that uh, each bottle is packed in a small box. Maybe 10 boxes makes a container. Sorry, 10 boxes makes a packet. Maybe 10 packets makes a carton, and maybe 100 cartons are there in a container. So it should be clearly visible from the packing list as to how these goods have been packed, so that it becomes easy for various assessing authorities like customs and all to make a sense as to how much uh, uh, goods are there and how they have been packed. And it also gives a comfort to the buyer that okay, goods have been packed properly from the point of view of safety. Then important document is certificate of origin. Certificate of origin is a document which is issued in order to prove that from where the goods have originated. In India, this certificate of origin is issued by Directorate General of Foreign Trade under Ministry of Commerce through their various offices located in various places in India. The objective of this certificate of origin is that it gives a documentary evidence that from where the goods have originated. So, giving you an example, suppose there are some goods which are being imported from, say, Nigeria, but the goods have been manufactured in China. So the certificate of origin has to be from China and not from Nigeria, because the goods have been manufactured in China. So the importer comes to know that these are Chinese goods. So in case if there is an embargo on import of Chinese goods, so they can actually plug it, and they can refuse taking it, that since the goods originated from China are not allowed to be imported into India. I'm just giving a hypothetical example. So it could be there in any of the transactions. Then inspection certificate. This is the specimen of inspection certificate. Uh, Sometimes what happens is that the buyer wants that the goods should not be dispatched unless they are inspected by some inspecting authority appointed by them, because they don't want to uh, waste time as well as money in transit for the goods, as well as time taken for the goods to reach, and then they realize that the goods are not worth it. So they want them to be inspected by their inspecting authorities before the goods are dispatched by the exporter. So such a certificate issued by the inspecting authority is known as inspection certificate. Then certificate of weight and quality. Sometimes what happens is that the buyer wants that the goods have to be of specific weight and quality, and they appoint a professional agency, say various professional agencies are available globally. So if they say that the seller has to get a certificate from such a such agency certifying the weight and quality of goods, so in that case they need to get a certificate of weight and quality for that particular transaction. Thank you so much for watching our channel. Your small action of pressing the subscribe button will definitely motivate us to make more and more educative videos like this. And our next episode 2 will be in continuation to the trade finance series. The next episode will be focused on transport documents. This is Rakesh Nanda signing off. Thank you so much. Have a good day.